Hi, my name is Tim Hart, Managing Director of Investment Banking for ATB Capital Markets. ATB has provided equity research of Mainstreet since February 16, 2017. Since that time, Mainstreet's share price has increased 470%, representing a compound annual growth rate over that time of 23%. We are here with CEO of Mainstreet, Bob Dhillon, and the CFO, Trina Cui, to discuss the Q2 fiscal results for the 3-month period ending March 31st, 2025. Before we get going, I'd like to acknowledge and congratulate you, Bob, on being awarded the King Charles III's Coronation Medal for your significant contribution to Canada and the province of Alberta.
Thank you, Tim.
Let's turn it over to Trina to walk through the key points of your financial results.
Thank you, Tim. In Q2 of 2025, Mainstreet achieved its 14th consecutive quarter of double-digit year-over-year growth across major key metrics under the extremely uncertain economic and market conditions. On an overall year-over-year basis, total rental revenue increased 12%, net operating income increased 15%, funds from operation increased 16%, in Q2 to $22 million compared to $19 million last year. On a per-share basis, the FFO per share increased 16% to $2.36. Year-to-date, FFO per share is $4.83. The overall operating margin has increased by 140 basis points to 62.3%. Vacancy rate in terms both overall and same-store has increased from 4.6% to 3.2% last year. This is mainly caused by a softened Calgary market. However, compared to the most recent quarter, Q1 2025, which vacancy landed at 4.2%, it still stayed relatively stable in this low rental season. On the same-store basis, same-store net operating income increased 10%, same-store revenue increased 7%, same-store operating margin improved by 150 basis points to 62.5%. So in addition to all the above-mentioned financial and operation metrics, Mainstreet is still holding a very strong position in anticipation of opportunistic market conditions in Q2 and the following quarters. For example, our cash position as of March 31st, 2025, remains at $210 million. That's more than $22 per share. Our current liquidity position for 2025 is $460 million. However, if we continue to stabilize our clear title assets and unleverage the value they have, our total liquidity position will be close to $800 million. So as an overall result, the Q2 once again demonstrates the continued success of Mainstreet's business model, which allow us to deliver compounded shareholder return, no matter where we are in the economic cycle, including the challenges we see today.
Bob, the quarter started in January with the re-election of Donald Trump as President of the United States. The President and his administration have been making many policy announcements and changes, including tariffs on Canada and other countries, which in turn had effects on the financial markets. Could you tell us what impact this has had on Mainstreet for your Q2, and what impacts could you see going forward as it relates to your ability to purchase new buildings, the cost to stabilize and reposition purchases, and overall rental demand?
Tim, I have a question for you. Have you read his book, Art of the Deal?
A long time ago.
A long time ago. As a teenager growing up in Canada, I want to be a real estate tycoon in my dreams, obviously. That's one of my first books I've ever read. And I remember when he did this apartment building deal, I forgot the city in the U.S., and he made a big score. I was inspired by that. So let's go back to your question. This is going to be obviously a tough time for Canada. Tariffs, whatever happens in Ontario, auto part, cars, and lumber is going to affect the rest of Canada. There's going to be a contraction. If the tariffs go ahead, there will be a contraction in our economy. But what happens? Great economic policies come out during tough times. Interprovincial trade barriers, lower interest rates. We are going to become an economic powerhouse if the right policies are implemented today. Yes, that's a big question, right policy. Are we going to unleash the energy superpower as we are, or the mining superpower we should be? Are we going to unleash it? So there's a lot of unanswered questions. First one, will the tariffs go ahead? Two, the right economic policies are going to make Canada boom. Now, direct question, how does it affect us? With the liquidity, like Trina has talked about, $400 million with a lot of clear title assets still yet to be financed, we in a cash flow positive, double digit, lots of liquidity to take advantage of the countercyclical opportunities we have today. Now, in terms of NOI, traditionally speaking, people do not buy homes unless they totally shut down immigration and international students, which I don't foresee happening. We're going to have more renters in a down cycle, especially in our segment, Tim, which is $1,200 rents. We have a working class workforce providers of housing, and 60% of all Canadians still make less than $50,000 a year. We're in this unique sweet spot. So, lower interest rates in slow economic times, affordability, mid-market, add value, Western Canada, counter-cyclical opportunity with the liquidity we have.
That's great, Bob. On April 28, the Liberal Party of Canada, with Mark Carney as their new leader, were re-elected with a minority government. Are there any proposed policies that will serve to benefit or negatively impact Mainstreet, including, for instance, immigration?
Generally, Liberal government are very pro-immigration. But even if you look at the present immigration numbers, you know what, Tim? I'm going to jump into the hard numbers on people are fixated how immigration is going to affect vacancy rate. Do you realize in the last 5 years, our population grew by 3.67 million? Just in the last 5 years, from 37 million to 41 million. And the supply of purpose-built apartments have grown by 278,000. So from 2.1 million purpose-built apartments across Canada to 240,000 purpose-built apartments. What does that tell you? There's a supply-demand imbalance between immigration, international students, international workers, population growth, and supply. But if that's the case, why isn't there a massive housing crisis? Actually, it's eased off. Right across Canada, the housing crisis has eased off. Not in all geographic locations, but it's off from year to year. I think there's a massive shadow market we have millions of people living in. Let me define shadow market. Basement suites, parents' basement, doubling up, multiple people living in one apartment, no different than Manhattan and some of these very tight vacancy rate. The hard data shows there's a lot of people in the shadow market, which is eventually going to go into mainstream market. When there's wage growth, who knows when or how that'll happen. But this is one critical data point that nobody talks about. So I anticipate 3 positive things that could happen in the next little while. One is mass migration to Western Canada. Well, let's just look at Alberta alone. While the rest of Canada has been growing at 1.83%, Alberta grew by 3.5%. 2024 and 2025 in-migration numbers to Alberta is 168,000 people. That's massive numbers. And out of that 168,000, 116,000 was international. So there's a mass migration. That's one. 2 is, again, I'm crystal balling a bit. What lever does the Feds have to stimulate the economy? One is interest rates. So I anticipate the interest rates to drop. So we got a lot of debt that's coming up for renewal and new debt that we need to place. A number one cost, Tim, is interest rates. So interest rates go down, real estate values go up. So that's number 2. Number 3 is real optimistic thinking. I think Canadians overall have come to realization one of the key economic drivers of our nation is energy. Are we going to unleash the energy corridor? And they've been artificially suppressed for the last 10 years. Are we going to let the wild investors, global investors, local investors to go out there and build our energy infrastructure, pipelines, more oil and gas, and more importantly, LNG? The world needs our LNG. Are we going to let them build it and export it? So that means this is really optimistic thinking. I think it's our turn, maybe the next decade.
You touched on basically supply and demand dynamics regarding the rental markets. Maybe you can touch on what you see in the M&A market for the next quarter and going forward beyond that.
First of all, we put a pause on acquisition Q1, Q2 because of the market dynamics on immigration, interest rates, President Trump's tariffs, economy slowing down. In the anticipation, there's going to be a buying opportunity. So I openly stated in Q2 President's message that I've paused. Now, if our cash flow wasn't double digit and a liquidity number wouldn't be this strong, like $400 million in 2025 alone, and we still have a slew of clear title assets, then I would be concerned. But no, we're in a very solid position to double down in this new countercyclical opportunity. There's lots of opportunity today, but I've paused on it, but possible distress, opportunistic acquisitions, maybe a drop in values. Now, that's crystal balling a bit, and most of the time I'm wrong, but there isn't a lot of buyers either.
Bob, your head office is based in Alberta. You got assets in BC, Saskatchewan, Manitoba, as well as Alberta. Can you remind listeners what your split is amongst those different provinces, and then also talk about the different rental market dynamics as well as the M&A market in each one of those provinces, if you don't mind?
Yeah, no problem. We are known as an Alberta company, but in reality, 43% of our net asset value is British Columbia. 21 geographic locations right across Western Canada, which means we got boots on the ground like an octopus, expanding in all these footprints. Out of our 18,635 apartment units, we have 10,000 in Alberta, and balances BC, Saskatchewan, and Manitoba. So our strongest base is still Calgary and Edmonton. Let me clarify Alberta. We have approximately 6,000 and change in Edmonton and 4,000 and change in Calgary.
And how would you compare this time right now? You've really maximized on countercyclical opportunities and grown the company. How would you compare this time to others with regards to the opportunity to grow the company even further?
Other countercyclical opportunities fundamentally affected the macro dynamics of apartment buildings, meaning revenues drop, prices drop, interest rates go up. This time it's different. Our revenue generally is not dropping. Sure, our vacancy rate went up 100 basis points, but I think the interest rates are dropping. Our replacement costs are going up because we always buy significantly below replacement cost. Migration numbers are clawed back a bit, but they're still strong. Alberta migration numbers are very strong. Everything fundamentally is solid. Is it psychological? Is it the tariffs? I can't really gauge the mood of the investment world. It seems like it's an open net for us.
Trina touched on your liquidity position. Do you think your liquidity position is large enough to take advantage of what you see going forward?
Definitely. There's two buckets of yes, but let me break down the two buckets of our liquidity. Trina touched on a liquidity of $400 million. That's only in 2025. And I'd like her to weigh in on our clear title assets, which are unleveraged for 2026 onwards. Go ahead, Trina.
The liquidity position that I mentioned is actually only for 2025. And in addition to the $416 million, if Mainstreet continue to stabilize our clear title assets and leverage unleash that capacity, our overall liquidity is close to $800 million in total, which can actually help us position really well for any opportunity you can actually finalize.
I'd like to add one more thing, Tim. Majority of our growth in 2024 was in British Columbia. And we have lots of smaller centers that we are consolidating. In Calgary and Edmonton, in BC, we are in like 10 cities.
Bob, walk me through the occupancy in your whole portfolio, if you don't mind.
Sure. Let's start off by starting at Winnipeg. Winnipeg is less than 2% vacancy rate. It's actually 1.7%. Then let's jump into Saskatoon, 2.1%, Regina, 2.7%, and then we'll go into Calgary, which is a sensitive subject because it went from very low vacancy from 2% to 4.6%. It's just jumped up. Now, that could be seasonal, or it could be the shadow market I touched on earlier. And surprise market is Edmonton, vacancy rate 3%. And most of the BC markets are like sub 3%, and they're really great, solid markets. One of the reasons is the supply-demand imbalance in some of these cities is just too significant to vacancy rate to ever go up unless something happens into the marketplace.
And if Canada falls into a significant recession, how do you see those occupancy rates changing?
We've been in business for 25 years and on the TSX for 25 years. And the best time ever has been during recessionary times where, sure, the vacancy rate goes up by 3 or 4%, maybe even additional 5%, but interest rates drop, costs come down, and it's a great countercyclical opportunity to buy. I'd like to add one more thing. Our average rent is $1,200 per unit. We are like the Walmart middle-class provider of affordable housing, which is the least affected. When you hear the headline news in Globe and Mail that the rents are dropping, they're referring to the $3,500 rents that are dropping. They're not referring to the $1,200 rents, which is a segue. Why is places like Saskatoon, Regina, and Edmonton have such low vacancy rates is because of affordability.
Can you touch on one more time the inventory of buildings which are being stabilized and your catch-up on NOI?
That is a really good question. The three organic, non-dilutive drivers of Main Street is our liquidity to grow organically. So that's why our asset base without dilution continues to grow. Second is the NOI catch-up. What the NOI catch-up means is 12% of our portfolio is unstabilized because we only buy assets that we can reposition and increase the top-line revenue, which is a fixed-cost business. And so there's a lag time when we buy the assets and reposition them and increase the top-line revenue. Usually takes 18 months to 2 years, and some places longer because of the Landlord Tenancy Act. That number is approximately $46 million NOI catch-up. Now, some would say it'll take you forever to do that catch-up, but we've been catching up every quarter by, Trina?
Year to date, we have caught up $6 million.
So you can use any number you want, but what does that translate, the NOI catch-up of $46 million, and if you use a 20 multiple, is an additional $100 increase in share value. Now, multiples change, recessions come, catch-up takes up a little bit longer, but if you look at our historical trend line, every quarter we do the same store NOI catch-up.
When you first put in your dividend, I'm sure some shareholders were quite happy with that and also happy with your dividend increase. Maybe you can touch on the dividend policy going forward.
That's another great question. Our objective of putting a nominal dividend was to open up lots of other buckets of investors. Our what you call shareholder base was constipated with all these funds, and these funds were looking for value play rather than the dividend play, which is the REIT market. So actually not all shareholders were happy that we initiated a dividend because they're saying you are a better compounder of wealth than they are, double digit for like 25 years. So they weren't happy. But we needed to increase our shareholder base, and we initiated a token dividend, which you're going to be hopefully increase year after year and become part of the aristocratic dividend pool. Our policy, if our cash flow continues, we will continue to increase the dividend.
Main Street's got a normal course issuer bid program. What are the plans going forward? Do you plan on utilizing the entire program going forward? And are there moments in time that you want to be buying shares? How does that look at as an allocation of your cash flow versus other opportunities?
First of all, we want to give the public an opportunity to acquire Main Street shares. But sometimes because of economic conditions and volatility, like the tariffs, we see dips in our share value, and we are trading at a significant discount to net asset value. we will step in and we'll buy our shares back, like we've done in 2008 on a substantial issuer bid and during COVID on a normal course issuer bid. If there's a significant dip, we will step in to buy. How much is a function of market conditions.
Bob and Trina, thank you so much for your time today. Congratulations on some very strong Q2 financial results. ATB's research analyst has got a target price of $225, certainly above your current share price. And thank you again for your time.
Thank you, Tim. We're hoping to surpass your target. ATB's been a great partner of Mainstreet. You have not only the investment banking department, your corporate finance department has a large acquisition line of credit, and you stepped up to the plate in 2008, 2009 during the financial crisis. You've been a great partner, great supporter. Thank you very much.
Thanks, Bob, and look forward to continuing to support the great growth of Mainstreet.
Thank you, Tim.
Thank you.